You really have to love pain to choose to be an entrepreneur.
Any company who's at scale today, you see there's a minimum of 10-year journey behind it. It's always more lows till you finally reach one high.
I think people have like shorter memories in the financial markets, but if you remember 2022 to 2023, India saw something like $50 billion worth of outflows, FII outflows.
This is the first cycle you're seeing in India about the whole secondaries coming into mix.
Secondaries is great, the market is good, the macro is great for the country, but as an individual investor, you still should be selective about your choices.
And if you choose the right partner, it's always going to work out for you.
And I think that forms the basis of the private market, right? The whole fundamental thread holding it all together is a thread of trust. Good to have you guys. I think we've been planning this session for a while, but finally all stars aligned and great to have this conversation. So thank you very much for joining.
Good to be here, sir. Thank you for having us.
Yeah, great to finally be doing this.
Yes. So, Vishesh, you've been in the whole world of entrepreneurial ecosystem for a long time, right? I mean, just curious, what got you into this whole ecosystem? How did the whole journey as an entrepreneur start?
So, I think it's a very simple and straightforward journey. I think I started my first company out of school, out of some family reasons, but more because there was no opportunity for me to pursue college anymore. But I had to just help him. So started with that opportunity where I had to just pitch in and make my own expenses meet. And then once you are in, you start seeing opportunities. So my first company, I started making a decent amount of money, which I realized that even if you are in a country like India, like back in 2010, even after a decent MBA, your packages are not there what I was already making as a freelance entrepreneur. I didn't have a company in place. I was just a freelance entrepreneur. But that also is more exciting in terms of this is possible, you can make money. And then tech was something I realized after reading a lot because Flipkart and all those things were just happening. So you realize there's a new opportunity in e-commerce and tech in general. And I was good with that too. That's how I gently entered. First company did well. It was a mobile apps company. And sold that very early on and jumped to the next one. But starting point was some mix of, let's say, my needs and the other was passion. I think that's it.
Oh, great. I think three of us at least have been in this whole entrepreneurial ecosystem for a long time. And I think we have all seen how the journey has transformed over a period of time. Beyond all the attractiveness of being an entrepreneur, I think I usually say that you really have to love pain to choose to be an entrepreneur because the kind of journey is really, really demanding. And I'm sure you must have been through your own highs and lows. Today, everybody who gets a package at home knows the name of Shiprocket, so I don't think it needs any introduction. But has this journey of highs and lows been something that you thought?
It's always more lows till you finally reach one high. I think it's going to be always, everything else will be a low. Yeah. There's only one high after a point. For us, it was a lot of pivots in the mix. What we started as was a different company or different product. We failed on that. We pivoted to another product. We again failed on that. But the journey of persistence that we stuck around and we chose one customer base, which was SMBs of our country, that was good. I think we did not change a lot from that direction while we kept on finding the right product. I think Shiprocket was one product that found its PMS in that segment. And that's where it really worked for us. But it's more, everyone sees the end outcome, but what you don't realize, there was a 9 years for everyone. Any company who's at scale today, you see there's a minimum of 10-year journey behind it. And that's what it takes.
So the overnight success took 10 years.
Everyone, but not just me. I think every other company we've seen, it takes that.
Right.
And there's a lot more that has gone wrong than right in your journey. It should not be too long. That's what you need to avoid.
And hopefully you learn from every mistake because
absolutely,
that's the only way to move forward. And Raj, you've been coming from the world of the investors. You've looked at multiple companies. This whole, the thinking of coming together, being a part of the Tribe Fund. Share a little bit about your journey. How did you get into the whole aspect of entrepreneurial ecosystem, the world of investing? How have you seen the whole ecosystem evolve?
Sure. I think just so that people have an idea about Tribe. Tribe is a quant-led fund, right? The reason I preface that is because my background is kind of correlated to why we got together as well. I started my career as an economist with McKinsey. So fairly quant-driven from the get-go, and did a short stint at the World Trade Organization as well as an econometrician. So the numbers and quants and things that fit used to work really well for me, right? my most recent stint before Tribe was I started my own fund after many years of investment banking and building relationships in the ecosystem. And even though it was an early stage fund, I tried to use a lot of rule-based algorithms and systems in place so that I could make more objective decisions, right? Because what happens is that when there is lack of data, you start going more towards qualitative and aspects which can't be measured. So I would try to figure out a way to quantify even the qualitative aspects, right? So I had a good link in terms of how I thought versus how Tribe thought. And when I was moving on from my previous fund to, and I was very sure that, it was the middle stages and the later stages that I wanted to be more deeply involved in. The core reason for that was also because when you have that kind of data in later stage companies, you have a better ability to underwrite those companies, right? And Tribe has a system called Termina, which has almost been, a decade in the making. What it basically does is it takes transaction level data and underwrites any kind of company that you have. It's like an X-ray on the company, right? I had known Arjun, I had known Vishesh for some time, but it's during that phase that we reconnected, right? And that's another story. But for the reasons that we got together was because we thought very similarly as to how do we want to look at companies.
So Raj, you talked about the whole quant way of investing. I think there's tremendous interest in that. But I think before I go there, I'm more interested in knowing how did two of you guys, come together to start the Tribe India piece? I think the global piece, and met Arjun a few times, we all know. Give us a little bit of a back to the behind story behind.
So I think it's interesting how it all panned out, especially why I am here. I think that's more interesting right now. So Arjun, of course, I know as an investor. He invested in Shiprocket. We started engaging with Tribe in 2018, and the first investment came in 2019, and he's been supporting the company since then. And we've had this investor-founder relationship, but he also was a lot more involved with us, like in our mentorship kind of way, where he did give us a lot of frameworks and guidance on how to scale the company, and kept on also following up on each round of investment. Last year, he came back with this concept because India portfolio was doing well for him, and he is a big believer of India's story, the growth story. He reached out saying that I want to set up a dedicated India vehicle, and for some reason he thought you should do it. And I asked him multiple times why. That my experience of running a fund is not there. So why me? His answer was very clear. He said, I know how to run a fund. What I need is what I did with you guys, the whole guidance, mentorship journey. And then he wants me to replicate that with other portfolios. Now the next step was the dynamics of how to run a fund. And that's where I reached out to Raj because he knows that part very well. And that's where I reached out to him that we need both expertise. While I can help the portfolio founders, but running a fund is a whole experience-driven game with governance and everything in place. And that's where Raj does that job very well. And we bring complementary skill set. So yeah, that's how we came together. And I've known him for a while. So that's how we came together around this.
And Raj, for you, how is it working with an entrepreneur, right? Because it's a very different headset, right? When you think about investments, there's a lot more clinical approach. There's a lot more data-driven approach. I think an entrepreneurship is both about heart and mind kind of coming in together, a lot of gut feel.
Right.
So, I mean, how do you guys, both of you, balance each other's roles?
So I think I've been working with founders for a better part of a decade now. So it's been quite interesting. But as for how the two of us also reconnected, I would say, right? So we'd known each other for a while, and I was figuring out my next fund, right? At the time that we both reconnected, and what I was doing were conversations like this, right? So I was like, hey, why don't you come over to the office? We'll have a chat, right? And let's see what's happening in each other's life, right? It basically started with something as basic as that. At my core, what I was looking at that point was basically having, co-GPs and partners with complementary skill sets, right? That was like my basic thing, apart from just being able to get along with the people, right? So that's why you go into your network of people that you know. So that's how we guys got together. And when Vishesh and I started talking, we realized that Arjun, Vishesh, me, we think about things and India as just a macro story, as well as an investing philosophy. We think about it in very similar way, right? We all believe that there should be objectivity in analysis. right, in investments. That's where the quant comes in. We all believed in the secondary stories in India because we saw that a lot of investors were not able to give timely exits to LPs. That's where the secondary market was booming. And this is where it's like a couple of years back now that we had reconnected and conceptualized it, right? So we knew that we were thinking along the same lines because we came from similar but different experiences. And more to your question about what it's like to work with the founder, it's always intense, but you want it that way. The good thing about our partnership and our relationship is that there are things that he is doing around me every day, which I'm learning from, and hopefully there are things which I'm doing on the fund side, which he's learning from, including how you're negotiating, how you're talking, how you are presenting. It's very different because you are on different sides of the table. But what's quite interesting is that at our hearts, all three of us are actually founders before we are investors.
Right.
And that's how we're thinking about Tribe India as well. That how do we grow this as a long-term business with long-term stakeholders who can rely on us for an extended period of time. So that's basically how we think about it.
Very, very complimentary, actually, with the way I think that you guys talked about. You referred about, the whole world of secondaries.
Right.
I've been personally in this whole private market industry now almost for about 8 odd years. And in the last 10 years, I've seen significant maturity. We were talking about 35, 40 odd funds, and we have almost about 400 plus funds now.
Wow.
That we have been kind of looking at. We have diligence almost about 200 plus funds. Second, in some sense, seems like, the private market or the entrepreneurial ecosystem in India to have matured, right? Tremendous interest globally in this, but I think I wasn't mentally ready that, the whole secondaries piece will get so much traction in such a short duration of time in the last year or two. Are you guys seeing something similar in that space?
Absolutely. And so there's a reason for that as well. So if you look at India's whole startup ecosystem is a decade old. I think 2010 when it started taking shape, and generally fund cycles are about, let's say, 10 years to the max. And the first funds that came around, the first investments of those happened in the early years of till first half of the decade of, let's say, 2010 till 15. Now they're nearing their cycles of fund closures and stuff, but the companies have also matured. On both sides, a great timing for secondaries because the companies have matured and funds want to liquidate exits. While IPO is one path, but there's all the other paths to it. So this is the first cycle we are seeing in India about the whole secondaries coming into mix. The excitement also I saw from a lot of people, and as a founder myself, within Shiprocket also we saw it's important to also make this whole paper money into real money at one point to make it sensible for everyone. Even my employees, my ESOP holders, my shareholders, but still that happens. The motivation starts going down. So that one cycle, it needs to happen. For our point of view, it's very important to now start making sure this is actually the value is real, which is not like the numbers we kept telling them are actually real and are worth something. You can actually buy something from it. And then on the other side, from a fund point of view, for HNI or anyone who's looking at saying that now I can enter for a short duration or at least reasonable duration and take a journey from here. There are two different sets of people. Less risky, the companies are matured, there is a path to the company, future is there. And now finally India's IPO market is fully matured.
Right.
I think everyone's in the line. The queue is there. In the next 24 months, we'll see, I think most of the companies who have matured and are fundamentally strong going public. So we'll see this whole ecosystem also becoming more and more liquid.
And I think the way, the moment Shiprocket kind of hit a unicorn kind of a status, some of your early investors would have seen what, like 30x, 40x?
More actually.
More. Okay.
So we actually also made this, it was for us personally, I'm not sure about everyone else, for us personally, it was a very big agenda. It was more of a responsibility as a founder towards my shareholders and investors.
Yeah.
That we kept on doing this on every cycle. So even when we raised our Series B, and it also, the other thing is, you'll always have people on your board who will somehow, as your company progresses, someone will lose confidence and trust in you, but someone else will have trust and confidence in you.
Right.
But we kept on doing this recycling of the board and we kept on making sure there's exits available. Because that is what makes it real.
So, yeah, and that's very interesting because, the kind of people who are coming out, they're making whatever 30, 40, 50x returns. And then there's a next set of investors who come into the next part of the journey, then who grow into the next phase.
Yeah.
And I think we're seeing a lot of the journey for the pre-IPO companies, right?
Yeah.
How there is a conversation that in absolute sense, a lot of value unlocking actually happens when companies are going through Series B, they're going through Series C, they're about to hit the IPO and so on. So that, are you seeing that a more matured stage is giving equally exciting returns as you have seen in the previous stage?
No, absolutely. I think I'll tackle it from both sides. One is looking at it top down, so the macro, and the other is bottom up, which Vishesh mentioned, right? From a founder going up. If I look at it from a macro perspective, right? You've spoken about like the last 10 years, but even if you look at the last 5, I think 2021 was the peak year, right? We had something like 11 IPOs, then it declined, then it was 3, then it was 5. This year is going to be above 15, I'm guessing, right? So from a macro perspective, there's been a tailwind. A lot of that is actually put up by our domestic institutional investors, right? So I think people have like shorter memories in the financial markets, but if you remember 2022 to 2023, January to January, right? India saw something like $50 billion worth of outflows, FII outflows, right? For all intents and purposes, Indian market still held its own because the domestic institutions had got stronger, right? So there is an appetite for newer age businesses, but it's not come easy, right? So let me flip now to the micro side. There are founders who are getting more mature about how to take their companies public as well. I was having a conversation with this $1 trillion allocator, FII, right? And I was asking them that, you tell me, why are you bullish? I can tell you why I'm bullish. And his response was that, look, I feel that the Indian founders are getting a lot more mature even in 3 years. I asked him to explain that. And he said that what was happening in the initial years was that founders would come out to the public markets and they would pitch like they would pitch to a VC, which is high expectations, right? I will get this. And the moment they got a little bit below that, the market punished them, right? But now founders are coming out with reasonable valuations. They're coming out and saying, giving reasonable targets, which they feel they can achieve, right? And public markets, when you achieve your targets, it rewards you. When it rewards you, it rewards all your investors, right? That basically goes back into building faith into the system, right? So I think it's a really good confluence of events from the macro and the micro side, which I feel that, is kind of getting people very excited to get into this market. There's still caution, which I would still advise, but yes, it is a real opportunity.
Right. And, at least when I'm talking to people about the entrepreneurial ecosystem in India, and especially the conversation is around valuation, most people say that there are only 2 kinds of valuation you see in the market. It's either expensive or very expensive. I don't think there is anything else.
Listen, I think that's where a lot of skill comes in. I think that's where, when you analyze a company, a lot of pre-IPO blocks, you will probably enter at a couple of billion in valuation. And everyone starts, and that's what I have had this question a lot of times where, what is the upside? If I enter something at 2 billion, 3 billion, what is the upside in a country like India? And that's where the skill is, to actually evaluate the addressable market, the TAM, and the company's potential to go there,
right?
Which is the skill that is needed. So how do you identify the right target company? How do you underwrite the asset at the right price? And how do you negotiate a good price entry point? Which is the skill in the play. There's always opportunity in, people say it's easier for a company to go from 100 billion to 1 billion, but it's very hard because they've not seen examples of it up until now. Now we have seen the examples, but for the longest time, up until last 2 years ago, people used to say, we have seen companies going from 100 to 1 billion, but a lot of times we've not seen any further upside from 1 to 5 billion.
Right.
That's been a very small number. The subsets become smaller. We don't need to look at examples. We have to look at companies' individual capability and potential. Once you start analyzing and underwriting the asset individually, rather saying no other company has gone, that's guesswork.
Right.
So,
yeah, and actually that's where the whole, I think the entrepreneurial ecosystem story is changing in India, right?
Yeah.
I mean, when I used to, go for some of these meetings in US or other parts of the world, usually there were 3 parts of the question, like why India, why entrepreneurial system, and why the specific thing that you're doing. I think the why India question went away a few years ago. I think now even why entrepreneurial ecosystem in India has gone away. So I think broadly, a lot of large institutional investors, big endowments are now convinced that India is a fine story. Entrepreneurial ecosystem is maturing. But are you seeing that for, the investors in India? I know you guys haven't raised much capital over here, but are you seeing more interest in the domestic market in terms of coming together, especially when you talk about, let's say, secondaries, which is typically a shorter duration, right? It's unlike a conventional 10 to 11-year product. You're talking about maybe like a 5-year kind of a window because these companies are mature, right? They have a faster path to liquidity. Are you seeing some of the domestic interest kind of pick up?
I am personally. So in my 10 years of pitching, we pitch to everyone. So I've seen interest from first VC category, but never from a traditional institution. So what I mean by traditional institutional investors are pretty much like people in like Ahmedabad, like who do only public markets. They started reaching out, saying that we want to now
Look at this asset class.
look at this asset class. When you see that, because I've had both sides of it. A couple of years ago, when we saw them talking or we met a couple of them, they were very against this whole asset class. And we don't understand this. This is not liquid. This is not real. I don't completely understand this at all. Versus now, they're finally, after the first few companies that went public from a startup ecosystem, they started seeing the trends, they started understanding it. That's where now they have realized this is an asset class which is real. They started reaching out. And then I think once they look at it, there's a lot of followers for them. But domestic institutions, I think now finally are picking up. Right. They understand there is real value in it. They understand the right entry points matter. And they want to now get in. I've heard these examples. I wish I would have entered an HDFC bank when it was on this step. So now they're using those examples that this is my opportunity.
And that's how they talk globally also, right?
Yeah.
When you look at the companies in US, when you talk about a Facebook or a Google and so on, I think those have created value. In fact, I was with one of the GPs, a leading GP in the industry, and I was just generally asking them, so where are you traveling? And they say, I'm going to go to Ludhiana, then I'm going to go to Chandigarh, then I'm going to go to Mangalore. So you start realizing that the focus is shifting so fast, where it's not just the large big cities where people are investing in this alternate or the private asset class, but the interest is now actually spreading across the board in terms of going down from smaller cities to understand how the returns are happening.
Right.
Now that you mentioned smaller cities, this is a funny story. Yeah. So as I have a large investor base, so some of them host their LP events, and they always invite some founders to come and present, and because they want to also tell their LPs what they're doing and everything else. I've been on one of these events in India where it was hosted in Jaipur, and I was just invited to present to their LPs. The perception going into an event like this was small event, couple of LPs and my investor. It was actually hosted in a banquet hall with 300 people in a hall. So all 300 of them were the LPs of that fund. And they were all private, small business owners who realized now they've started learning about this asset class. Half of them might already have invested and half of them might be just evaluating. And the concept and the whole theme of the event was one of the portfolio presenting to tell them how your investments, how do we put your money in right places. And then some 5 new pitches where they give the opportunity to invest on the event there and then. It's like a Shark Tank style thing, come and invest in your companies, and these people have the opportunity to invest in your company. In one particular pitch where this one company presented, he said, I'm raising 1.5 crores and I'm open to take 5 lakh checks from this audience per minimum check of 5 lakhs. So if anyone wants to invest, please reach out to me. Very traditional SMB, someone stood out from the hall. He said, how much is the total allocation? He said, I just told you 1.5 crores is the total, but you can do 5 lakhs minimum. He just stood up saying, I'll take the whole thing. 1.5 crores, done. Because they do have the capital.
Right.
And that's the beauty of the country. All of them are sitting over liquid capital they want to deploy. They understand money makes money. Someone needs to explain them. Once they get it, there's a lot more interest. It was very funny, but a lot of enlightening, saying that how this works in India and how it has changed over the last few years, where every small business owner, traditional business owner is looking at this asset class as a when you distribute large cap, small cap, this is also now in that portfolio basket where it is now been done in a format mid cap, large cap, small cap, unlisted.
Wow.
So it's there now.
But that also sometimes brings up the concern to say that, let's say, the world of secondaries that we were just talking about. A lot of people are saying, I got 20% discount, I got 30% discount. But, there's no reference point.
Yeah.
So the ability to understand a company, the ability to diligence, the reason why regulators are very, very particular that this is a private asset class and you got to be able to be mindful of that. How do you guys see that? Because, that's a big, big challenge. The information, the transparency, the performance. It's not that people are hiding it, but it's not available. It's not transparent.
I think that's why I said, right, like when I was speaking, that I will still advise caution to people who are entering this asset class. The reason is that, people, the actual principle that you have to really stick by is high quality at a reasonable price. But because we are Indians at our core, we want that discount first, right? Somehow that drives us more. I think that base instinct is something that as a society, as a community of investors, right, we have to tame so that we become better investors. Because high quality comes before reasonable price. You have to be able to underwrite an asset and have that conviction to be able to say that, hey, this is a quality asset. But it's a quality asset and this is the price that I'm getting, right? That's the conversation that you want to be having, right? Because the thing is that if you start with the price, right, it's not exactly investing as much as it is speculating and seeing where your returns would go, right? But as an investor, you still want to figure out a good price, right? But the underwriting of the asset, that still should be your primary, gateway.
I think this leading indicator changes. A lot of times, I have also got pitches from allocators saying that, I have this asset, his peak valuation was 10 billion. We have access at 2 billion. The point is, it may or may not be wrong. It's like you have to analyze the company's potential individually. So if you want to enter the asset class, having the right network to do that is super important.
Right.
What network are you using to deploy your capital is very important. The network could be of wealth advisors who personally have not done the work themselves, who might have got access through. It's very important to choose your allocation path. Someone needs to do that work individually on each company. And if you choose the right partner, it's always going to work out for you. Well, it's maths. It's not guesswork.
Right.
You just know something can be 80% discounted, but it might not be even worth 100 million.
Yeah.
Or something actually could be a great opportunity because, giving Shiprocket example, because I can use that. There was a time when we were at a stage where a lot of people lost interest at a price points of 50, 70, 80 million. Like, this company doesn't have a lot of potential. And that is a great opportunity for someone who understood the potential versus someone who did double down. So someone who understood, we had a match. Someone who did, they exchanged. He still made a lot of returns, even at 100 million exit point. But someone who entered at 100 million also made a lot of return. Right. It's about timing and very basic maths. Doing the right work and underwriting the asset is super critical in this process at every stage.
And I guess that's where your quant approach kind of steps in.
Correct. And we use, I think, underwriting as a complicated word, but honestly, it's just core research, right? In terms of being able to understand the asset that you're investing in. Vishesh was mentioning about Shiprocket, right? Something which has happened with Shiprocket and us being investors there is that every time that there has been anybody who's wanted to exit and we've been finding a good number, we've been able to double down because we have the conviction in the asset to begin with, right? You cannot do that if you are spreading too many bets around, right? Which is why I keep coming back to the same point that secondaries is great, the market is good, the macro is great for the country, but as an individual investor, you still should be selective about your choices, right? You still should be doing it actively. It's not an ETF, unless there is something like that. That's another issue altogether, right? But if you're individually going into assets, you should spend the time. You should do the research. Yeah,
and that's just entry point. I think one thing I learned from Arjun was the more important thing is the exit point than the entry point. So realizing and keep on doing that work and not hoping for your investment to work is something that you should not. So
yeah, I think
fund managers is always important to keep track on. Entry point is one part of the journey, which is 10% of the job.
Right.
The 90% is when to actually exit. Because some things can look great on paper, but very important to choose your right exit point.
One of the things that I always wonder is that in the world of secondaries, for someone to come in, someone is exiting, right? So the question always in the mind is, what is making the current investor exit? So when I'm putting my money in, I would always be wondering that, am I entering an asset where somebody else is more keen to get out? Or am I entering for the right reason? So I'm sure you guys would have come across something like that.
And this question has been asked me multiple times. I think if as a founder for each of my rounds, when there was a mix of secondary and primary, every incoming investor would ask, why is the other guy exiting? Because he's underwriting you for a 5 to 10x upside. And if someone is exiting, he is doubting that he has known you much longer. So something is wrong if he's exiting. Right. So what we need to realize is, how are these funds structured? And disciplined funds specifically. While there will be reasons where somebody is exiting because something is wrong, there will always be that, and that's where the skill comes in to identify that. But the larger areas, there is funds like seed funds, then you have growth funds, and then you have the late stage, pre-IPO stage fund. So every fund is structured in a certain fashion. A seed fund, disciplined ones, have already predefined targets of IRR and returns. When they hit that, they want to liquidate, because their skill is to identify next set of seed funds. So they recycling the capital back to their fund, saying that my skill is to identify seed stage deals and then make my X% or X% IRR and then exit. If they are disciplined, they will always do that. And that is the opportunity for a growth stage fund to come in and buy them out and take the journey from here on. And also the value they can add to a company is different. For a seed stage fund, they can add the value and take the company to a certain stage. But even a company needs a different set of people for their stage of growth. So we have been replacing this basis what we need at that stage as a company which we need growth from. And they are not exiting because they have lost trust or something. They cycle and it's
not a lack of faith.
It's just their targets are hit. So disciplined funds always work on this format where they have a set target in mind. They hit a target and not be too greedy, which is the mistake that a lot of people do in this cycle, and they hit their targets and they take exits. But for them, it's fair. IRR is all about time, like what is the time and return in the time, and they have their targets. And so that is when the opportunities come in. When it comes to pre-IPO blocks, for people who invested in growth stage, for them, it's also, they will have to hold it for next longer period. Their targets have been hit if the company is done well. So that's where they will probably not say, okay, I'm exiting fully, but they would potentially dilute a small percentage of their holding. And that's the opportunity that comes around in the block.
Right.
It's not always the case where they've lost trust, but everyone wants to recycle their capital to do what they know best, is going back into the companies at certain stage, which they have built expertise in. A lot of the opportunity.
As somebody who is on the fund, I can relate with that. So that's from your perspective, you look at probably about hundreds of companies before you narrow down on a bucket of, let's say, 5 or 6 companies where you want to do secondaries. So does it matter also where you're sourcing this secondary from, who is facilitating it? Do all those aspects also play an important part in your decisioning?
Look, I think I will always go back to the fact that from where we are getting the source of the lead becomes less important as long as we are getting right information on the lead, right? And I think that's because at the core of evaluating a company comes those building blocks, right? Which is data. For us, from our quant-based approach, is getting transaction-led data, right? So that we can build out a complete picture, right? And then get into secondaries. More on, I think Vishesh touched upon this as well. It's just the nature of markets that and companies that as they evolve, it'll start with a lot of primary, and then as they mature, there will be more and more secondaries available, right? If you look at a massive company now, like an HDFC Bank, most of the exchanges which are the transactions are happening in the open market, they're all secondary transactions, right? So at that point, we don't ask that, why are you selling, right? But the reasons are actually very similar.
That's very interesting.
Because the thing is that I'm selling because I was holding on to HDFC for 5 years, right? This is not investment advice. My life cycle is run because I find other opportunities. I feel the opportunity cost of this capital for me is better if I put it somewhere else, right? Which is why I'm exiting. But when you trade on Zerodha or anywhere else, you're not looking at that, right? Because every time that transaction is happening, somebody's selling. That's why you're buying, right? Even though it's not zero sum, but it kind of works on a very similar principle, right? That now the company is so mature at that level, it's generating its own cash, and investors are transacting between themselves on the value of the company, right? But yeah, I think that's how we look at it. We don't really think about where a transaction need is coming from, so much as we think about, hey, what is the stage of development of the business, right? What kind of cash flows is the business seeing? How will those evolve with the market evolving, right? So all of those will kind of feed into our quant approach to be able to kind of put on the map, right, that what is the stage of development of this business and how is it going to evolve given the market dynamics. For us, that becomes the core.
In some sense, involving the founder would perhaps become important for you guys, because since you're diligencing the company, you're probably buying the stake from another angel investor or a seed investor. But for you to get a fundamental appreciation of what the company does, where is it heading, right? Ensuring that the transaction goes through successfully. I guess it's fairly critical for you to have founder in the loop or involved in some shape or form.
Right. So I think one thing to understand, right, is that we're not predominantly secondaries investors. We do both, right? And the usual stages that we enter will be anywhere when a company is above $100 million in enterprise value. So we will be doing a bunch of secondaries, primaries along the way, along with secondaries, right? So for us, it's critical, right, to understand the business bottom up, right? It's not just about who's selling, what are the shares being sold, but like I said earlier, right, high quality first. So we will first assess for, is the quality of the asset, good in its own right, and that's where we kind of then, once we know that, hey, it's a good quality asset, we might want to average our price a little bit lower. So we'll get secondaries in, and in that case, we will of course have those conversations about who's exiting, why they're exiting, and usually it's never a single reason. Different people have different reasons to exit, right? But you can stand by all of that as long as you have your rationale for why you're buying and where it's headed.
Right. I think the approach is also different, where you don't start the conversation with, I have an asset which was, last round was 2 billion, I have my secondary available at 1. That's not where it starts. I think we have been more from a side, we have been identifying assets and we approach directly to the founders and the people. The conversation is never between just like a seller and a buyer. The founder has to be involved, which is the most critical element here, because we are underwriting the asset as a investor. So the process remains the same what a primary investor would do. It's the same process, just even if you're buying it from an angel or a secondary deal, the process should not change. But diligence, underwriting should be seen.
Right. In continuation of what you just talked about, Vishesh, so is it a bit taxing for a founder to be continually involved in these kind of secondary transactions during the journey of the business, because you actually have a real business to run?
Yeah.
Right. And then there are these myriad transactions which are happening where people are entering, people are exiting, and you got to be in the loop.
So if you are in a venture funded company or ecosystem, I think a certain part of the company's job becomes to reach out to new investors always to raise primary capital. This doesn't really change for our secondary side also. The process for our side, what we have established, we have investor relationship set up, we have our finance set up, CFOs, everything is in the mix.
So it's a part of the regular.
It's a part of regular business, or like daily business operations. It's nothing like it's too taxing. We are having conversations for both sides reasons every day. So nothing changes from that aspect. It's actually good from a lot of point, because if I'm able to recycle capital, and I need certain different set of people for a certain growth journey. So let's say if I want to expand globally, I would want to get someone who can help me do that.
Right.
And I don't want to dilute anymore. The company doesn't need cash. If you're running a profitable company, you don't really need cash anymore. And that is the point. You would want to replace someone who's actually made good return. And if you have good relationship, we have been able to do that a lot, where it's almost like we're requesting them, please, we want to bring them in, we need space, and we request someone, please give us some space. So they will do that for you.
Right. Very interesting. Also, the whole world of private investments is actually full of various kinds of myths as well. Right. Now, secondaries being a new, fast emerging space, I'm sure it has a bunch of its own nuances, which creates a bunch of myths all around. Any ones that you come across on a regular basis where you're like going really crazy in your mind that where did this thing come from?
And the biggest is, we've touched upon it previously as well. The biggest I've always heard is, I have access to this asset class at 60% of their last round price.
Yeah.
That's the biggest thing. People see that 60% as their upside potential. That's my biggest thing. And every time someone's pitched me like that, it's scary.
You're skeptic.
It's scary, almost,
Scary.
because you don't always underwrite anything like that. But I just found something which is 60% discount from its last price or at its peak. First, why it is going down is more important. That's the biggest myth. People see that 60% is upside. I think the other one would always be people following up with the brand name. Look at their investor set. Someone just invested in this company. This guy or someone invested in them. So there is clearly upside potential. You should definitely follow. That's the two things I have really heard a lot, because there's no real work, there's no maths around it. You're just making guessworks.
So the lure for discount, irrespective of the quality of the asset and the credibility of the investing founders or the funds to count on the growth. Raj, anything from your side that you come across?
I think people forget in the whole speculative mindset around it, right? People think of this as, as a lottery ticket. Any asset can be a lottery ticket because I'll buy, there'll be a huge bump up and then I'll exit. But at the core, you have to actually go back to understanding just a broad difference between public and private markets, which is basically three things, right? Pricing of the asset, liquidity, and monitoring, right? Those are the three things that shift from going from private to public, which also changes the archetype of investors, right? Investors who don't like illiquidity, who want to know at all times what the price of their invested asset is, and who want that monitoring to be, and the corporate governance levels and everything else to be like at a standardized, regulated level. For them, it's public markets, right? The idea is that a lot of people think that because I'm entering at a stage from which from the next step the asset is going to become liquid, right? So I will make a lot of money, right? That's not always the case. It all goes back to the same concept, which is that you still have to be a mindful investor, right? That is not something which changes between public and private markets. The markets will reward individual underwriting and understanding of an asset, right? And at your core, you still have to do that. If you're looking at an asset which is already public, you'll still look at the balance sheets, you'll still look at the financial statements, you'll still try to understand from the annual reports where the business is headed, right? You still need to be able to do that, right? People are under this misguided assumption that everything which is going to go public is going to go and skyrocket, and my money is going to...
And we have seen that it doesn't play out.
Exactly.
In fact, I'll just pick on one of the sentences you made about corporate governance, managing exits and so on, because I have personally had, one challenge that because of being in this ecosystem, you get information, you get access to a lot of direct deals. But what I personally realized over a period of time was that once you have done 5, 10, 15, 20 transactions, it just becomes super complicated to manage. So entering is easy and sometimes exciting. But then, the way I understand is that you're also talking that not just about the investment, the diligence and so on, but packaging it together and then monitoring it to actually drive a time-bound exit of those transactions together. And I guess that's where equal amount of strength comes in, or probably more strength comes in terms of ensuring that once you have entered 4, 5, 6 transactions, which you could have done probably individually as well, if you're deeply connected in the ecosystem, but making that as a combined portfolio-based exit in a defined time frame. Is that something that takes a lot of your time?
We think about it a lot, but the thing is that because of our macro quants that we have in place, there's not a lot of feelings or emotions which are involved with that decision, because we're actually able to read that in the data. Something very simplistic to put down is that even if you can track capital flows, which is basically amount of capital in an economy, and then if you can break that down by different sectors, is it abundant or is it scarce? You will get an idea about which can be a good entry or exit point, right? Of course, there's a whole thing that you should not try to time the market as a long-term investor, etc., etc. But at the same time, if you can have a decision-making process based on data, which is if there is a lot of liquidity in the market, how can you do that? You can track money supply, right? That's what we do, right? So we can say that because interest rates are lower, there's money printing happening, this economy is getting so much money. And within this economy, let's say AI or infrastructure, banking is getting even more money in the private markets, right? So what we are doing at that point is trying to understand the abundance or scarcity of capital in an economy within a particular sector. So which helps us also understand what can be a good entry point or what can be a good exit point. If there's abundance of capital, there's likely that valuations are going to be higher than anticipated.
Correct.
Right? Similarly, if you look at the public markets as well, that's what you want to do. When you're seeing that there is abundant supply of capital, right? And this is what happened, right? In 2021 up to 22, market was just there was so much liquidity which had come in from the US, from global global easing, right?
Right.
That the markets were at an all-time high, but people were not exiting because that's where another concept comes in of greed and fear.
Right.
Those are emotions. Greed and fear are emotions, right? Whereas abundance and scarcity are objective, quantitative metrics,
Which you actually look at in your quant report.
Yeah. That's exactly all we do.
Right.
It's just
So that's a very, that almost makes it a full continuum of investment, right? Identifying the opportunities, figuring out what the future potential is, diligencing, quant approach, understanding the founders, figuring out what is the right level of discount, depending upon each individual case and not having like a blanket view to that. Then managing those secondary positions for a period of time and then driving an exit. So that basically is the whole continuum that you guys would manage hands-on for an incoming investor, I guess, in this case.
I think that's the textbook job of fund manager.
Right. And I think there are specific nuances which may be unique a little bit to, let's say, a secondaries product, especially because in some cases, let's say you guys are talking very transparently about that. You're pre-declaring the assets. So there is a different kind of a skill set that goes in versus a blind pool where you're completely trusting the judgment of a GP over a period of time to say, I'm giving you $100 million, but you decide what you want to invest in, versus a situation, like your present fund where you actually have specific names and there is a complete transparency. The information and the stats are shown upfront. So I guess a different level of clarity you need right at the start of the journey versus something that a GP would develop over a period of time.
There's also very different approach where the founders need to trust you a lot, specifically at a stage where you are entering at. Why will I get the opportunity versus the other guy? Because they are very careful about who they are bringing on as shareholders after a certain stage. It really matters to every founder. So building that trust is also one or more added responsibility there with the founders as well, where they want to deal with us versus not a lot of people together.
And I think that forms the basis of the private market, right? The whole fundamental thread holding it all together is a thread of trust. And I guess that's where probably you being a unicorn founder and you being in the industry for 10 plus years, hopefully, that brings us together and strengthens the whole equation.
That's the reason we have been able to also, relationship was the biggest thing you get allocation in the first place as well.
Right.
It's not the only thing, but it definitely adds a lot of value because they are okay with you being around the table with them in the growth journey, because at those stages, they're probably looking at clearing up cap table more than adding more.
Right.
And that's where the whole
consolidation.
If you are getting access is a very important thing based on relationship, because that trust is there. You see that.
Yeah, I think also just to add to that, right? For us as Tribe, as a brand, right? What we always want to do, no matter who the founder is that we are analyzing, we feel that if they've trusted us with their data, and this is a concept which is like goes throughout the venture ecosystem, right? When you meet a founder, you ask for data, you ask them for a certain amount of analysis, and then you give an answer. What we felt was that if we return our quant back to the founder, that's the first thing that we do. Whether or not we invest in you or not, you will have a 70 to 100 page report, which would take any large consulting firm months to churn out. We do it in 48 hours. We will give it back to you, and we'll walk you through exactly where your business is benchmarked along every metric, right? That's our sense of how we want to add value. Because at the end of the day, from an investing standpoint, every investor will, even if you have 200 companies, it's still limited. And ours is even more limited because we do a very concentrated portfolio, right? So we may not be able to invest in everybody, but we do try to help as many folks who come across, right? Because this is one of the pet peeves of founders, right? Having operated in the ecosystem, and probably Vishesh can speak from a founder's perspective as well, that they will always say, right, in hushed tones, that sometimes loudly, that hey, VCs take our data and then they ghost us, right? That's an issue, right? And the thing is that I know it's painful because people spend time, it's bandwidth which they are taking out from making the business. So I feel that from an investor community perspective, we wanted to add that value back, and that's worked out for us. But more than anything, we also want the investor community to be looking at quantitative metrics more, making more objective decisions, because that will lead to more successful outcomes, which will lead to more investors, which will lead to more capital, right?
And that's a super way of thinking about it, that whether you invest or not, your quant-based approach of evaluating companies hopefully a good enough value add for a lot of entrepreneurs in itself.
Yeah.
Great. Thank you so much, guys. Lovely conversation.
Thank you.
Good luck with your fund. Best wishes to Tribe India and taking the journey forward. I look forward to seeing you guys again.
Thank you so much.